Something is spreading through precious metals communities right now, and it's creating real fear. Posts claiming the IRS just set new limits on how much silver you can legally store at home. Videos saying if you own more than a certain number of ounces, you're automatically flagged. Threads insisting that exceeding a federal possession threshold triggers an audit. Let's stop right there. That headline is partly false and partly pointing at a very real danger that almost no one is talking about correctly. Here is the clear truth. There is no new IRS rule in 2026 that limits how much silver you can store in your home. There is no federal possession cap. There is no ounce threshold that automatically flags your return. There is no reporting requirement simply for owning physical silver purchased with after-tax money. You can legally own unlimited silver. You can store it at home. There is no audit trigger based solely on how much you hold.
That specific viral claim is fabricated. But here is where it gets uncomfortable. The outrage over the fake rule is distracting people from the real one, and the real one has already cost investors hundreds of thousands of dollars. And that real rule has nothing to do with how much silver you own. It has everything to do with how you bought it. Let's break this down carefully. The confusion spreading right now comes from three separate regulatory systems being mashed together into one scaring headline. First, the IRS and tax court prohibition on home storage for metals held inside a self-directed IRA. That rule is real. It has been tested in court, and the consequences are severe. But it applies only to metals held inside retirement accounts, not silver you bought with your own after-tax money. Second, state-level dealer reporting laws. Some states require dealers to record identification or hold metals for a short period when you sell them. Those are transaction laws. They apply when you sell, not when you store. Third, federal cash reporting requirements under the Bank Secrecy Act. If you pay more than $10,000 in actual cash, paper bills, money orders, cashier's checks, in a single transaction or related transactions, the dealer must file Form 8300. But again, that's about cash transactions, not possession. When you take those three real frameworks, strip out context, and glue them together, you get the viral panic message: IRS limits home silver storage and audits you automatically. It sounds credible. It contains pieces of truth. But it's wrong. Now let's talk about the rule that actually matters. In 2021, the United States Tax Court decided a case called McNulty versus Commissioner of Internal Revenue. That ruling has nothing to do with how much silver you own. It has everything to do with where retirement account metals are stored. Here's what happened. A couple set up self-directed IRAs. They rolled retirement funds into an LLC owned by their IRAs. That LLC then purchased gold and silver coins. Those coins were stored in a safe at their home. The promoters of this arrangement marketed it as a legal home storage IRA or checkbook IRA. The pitch was simple: create an LLC, let your IRA own the LLC, have the LLC buy metals, and store them at home. They were told this structure kept everything compliant. The tax court disagreed. The judge ruled that physical possession of IRA-owned metals by the account holder constituted a taxable distribution. Not a small violation, not a warning, a full taxable distribution of the value of the metals. The couple faced income taxes on the entire amount plus penalties. The financial damage exceeded $300,000. The court's reasoning was clear. IRA assets must be held by a qualified trustee or custodian. Independent third-party custody is required. If the account holder has unfettered control over the assets, meaning they physically possess them, the law considers that a distribution. It does not matter if an LLC is involved. It does not matter if paperwork is perfect. If the coins are in your safe and they were purchased with IRA funds, the court says that is a distribution. That ruling still stands. And companies are still marketing home storage IRA arrangements. This is where real risk lives, not in the amount of silver in your basement, but in whether that silver was purchased inside a retirement account and stored improperly. Now let's talk about audits. Because fear videos love saying you'll be automatically audited if you exceed X ounces. That is not how audits work. There is no federal registry of silver ownership. There is no centralized database tracking ounces stored in safes. There is no reporting requirement for holding silver purchased with after-tax money. Ownership alone does not trigger audits. Audits are triggered by discrepancies and transaction patterns. The real audit triggers for silver investors look like this: unreported capital gains. Physical precious metals are treated as collectibles under tax law. If you sell silver at a profit, long-term gains can be taxed up to 28%. Short-term gains are taxed at ordinary income rates. You must report gains on Form 8949 and Schedule D, even if no 1099-B is issued. Failure to report gains, especially repeatedly, can trigger scrutiny. Second, unreported IRA distributions. If you moved retirement funds into metals and physically possess those metals at home and no distribution was reported, that mismatch can trigger attention. IRA custodians issue Form 1099-R when distributions occur. If the IRS sees contributions but no proper reporting, that can create red flags. Third, large cash patterns inconsistent with income. Banks file currency transaction reports for cash withdrawals over certain thresholds. Dealers file Form 8300 for large cash purchases. If those cash patterns don't align with reported income, that can attract scrutiny. Notice what's missing from that list. There is nothing about ounces owned, nothing about home storage quantities, nothing about automatic possession thresholds. So what is the actual legal picture? If you bought silver with after-tax money outside any retirement account, you may store it wherever you legally choose. There is no possession cap, no federal reporting for holding, no audit trigger based on quantity. If you bought silver inside a retirement account, traditional IRA, Roth IRA, SEP IRA, solo 401k, it must be held by a qualified custodian or depository, not in your home, not in a personal safe deposit box under your control, not through an LLC workaround. Independent third-party custody is required. If you sell personally owned silver at a profit, report the gain. Every time, regardless of dealer reporting. Compliance removes real risk. Now let's move into practical steps. First, determine which category your metals fall into. After-tax personal purchase, you're fine to store at home. Retirement account purchase, verify custody immediately. Second, if you are currently storing IRA-owned metals at home under a checkbook IRA structure, speak to a qualified tax attorney. Correcting an arrangement voluntarily is far less painful than correcting it after an IRS examination begins. Third, document everything. Maintain purchase records. Keep dates, amounts, dealer information, and cost basis. Store copies digitally in a separate, secure location. This protects you for tax reporting and insurance purposes. Fourth, review insurance coverage. Standard homeowners policies often cap precious metals coverage at very low levels. If you're serious about stacking, proper insurance matters. Fifth, report gains accurately when you sell. Compliance is not weakness, it's risk management. Let's summarize clearly. There is no 2026 IRS rule limiting how much silver you can store at home. That claim is false. You can legally own unlimited silver purchased with after-tax money. There is no reporting requirement for holding it. The real legal risk lies in improper storage of retirement account metals. The tax court has ruled on this. The consequences are documented. And thousands of investors are unknowingly exposed because they trusted marketing that framed a loophole as law. Know which category your silver falls into. Separate fear from fact, and understand the difference between ownership risk and structural tax risk. Physical silver remains a powerful tool for wealth preservation, but power without compliance becomes liability. Clarity protects you. Noise distracts you. Focus on what's real.